What's up, guys? Thank you for tuning back to Token Metrics TV. This is Jad, the quantitative analyst at Token Metrics, and this is the Quant Insights. So, what happened? June 22, Bitcoin was 33K, dropped down to 28K, and then just shot back up to 33K in just less than a day. So, why these levels? Why Ethereum had the same thing? And what is a gamma squeeze? Because whether you like it or not, it's always about options with me, and gamma squeeze is literally an options play. So I'm gonna keep talking about options, and options, we can keep talking about them forever, and there will still be a lot to talk about. So bear with me, there won't be a lot of math in this video, but there will still be a little bit. So let's look at the Bitcoin chart. On June 22, we had a huge drop from 33,400 all the way down to 28,700, and then all the way back up to the same level in such a short time. And during this drop, everyone was thinking, wow, like Bitcoin is over, Ethereum, same thing, Ethereum is done, crypto is done, it's the bear market, it's the crash, it's coming. But then it shot right back up. Ethereum similarly went from 2K all the way down to 1,700 and then shot right back up. So let's talk about why these levels specifically. And to discuss this, we need to explain the gamma squeeze. To explain the gamma squeeze, we need to do a little bit of math, just less than a minute, so bear with me. So this is probably the most important equation in all of quantitative finance. It's the Black-Scholes-Merton equation of option prices. So just to explain it very quick, don't worry, I'm not going to go deep in the math or anything. Just to give you background, V is the variable for the value of the options contract. And by now you should know what are put and call options from my previous videos. So V would be the value of the put or the call option. And these are the Greeks. You probably have heard of them. Essentially, this is just saying that the value of an options contract has a time component that is called theta, has a component called delta, which is essentially how is the price of the option changing with the price of the underlying, which is Bitcoin or Ethereum, and how is that delta changing with the price of Ethereum and Bitcoin. So you can think of this as speed if you're into physics, and this as acceleration. So let's talk less math and more intuition. So what is a gamma squeeze? Consider this example. Let's say Bitcoin right now is at 40K. And traders, a lot of traders, are buying puts on Bitcoin with a strike of 35K. When you buy a put option, whenever the underlying price goes up, the put option value will go down. And that means that it has a negative delta. And whenever traders are buying these put options, where are they buying it from? From a market maker, because the market maker's job is to provide liquidity. So whenever I want to buy an option, a market maker should be willing to sell it. And since he has to sell it to keep the markets liquid, he has to offset the risk associated with it to stay delta neutral. So whenever a market maker is selling me the put option, he has a positive delta, because whenever Bitcoin price goes up, selling the put options mean that the value will also go up since you are short that option. So you will have a positive delta, and this is bad for the market maker because he will have a huge risk. And a market maker only makes money from spreads, which is the difference between bid-ask. He doesn't make money from the direction of the underlying price. So he always wants to be delta neutral. And that is the main cause of what's called gamma squeeze. Now to explain it more, so we said Bitcoin was at 40K and a lot of people bought puts at 35K. And the next day, Bitcoin drops to 37K. So these put options have more value now. So the traders that bought these put options have gained, and the market maker has lost some value. Not a lot, because the option is still out of the money since it didn't go past the strike. So now, since the value changed, the delta also became bigger, because Bitcoin is approaching the strike and is approaching to become in the money. So market makers, with that change, they need to offset the change in delta, which is the gamma. So To offset that change, they need to short the asset itself. So since they sold a lot of puts, if price goes down, they're going to lose money. So to offset that, they need to be short that asset itself. So this means that they're shorting this asset while a lot of people are buying puts on it and the price is going down. So that will accelerate the price decrease by a lot. And this is why you have these sudden crashes and jumps due to the gamma squeeze. Now, enough with math. Let's learn metrics. So here we have the open interest for Ethereum for June 25 maturity for puts in the dark color and calls in the blue color. So just by looking at this, we know that the max pain is $20.80 for Ethereum. Max pain means where is the maximum loss for the buyers of options. It's where Ethereum ends at 2080 at June 25. This is where all the options buyers will lose the most because most of these options will be out of the money. And that specific point is the maximum gain of who the market makers, since they are collecting all the premium associated with this price. So here, looking at the put distribution, we can really see how the gamma squeeze will happen. Because when Ethereum dropped below 2080, we can see that there were a lot of put options being traded at 1920, much more than call options, which means that if Ethereum ended up crossing 1920, all these market makers, they needed to short Ethereum to offset their delta position and stay neutral. So that is why Ethereum dropped very quickly below this level and then went straight to the range between the next level. It didn't go all the way to 1600 because there was a resistance at 1700 and there were some call options that offset this drop. So what is max gain? You remember my nice Ethereum put option Excel sheet? Max gain, very simply, is where if I'm buying all these puts, where is my most loss? This is the max gain, wherever Ethereum finishes between 24 and 2500, because I bought puts that have these strikes. So this is just how to show you how we find the max gain. It's where all of my options are out of the money and I lose all the premium and the market makers make the most money. So why 1700, 1720? That range was, in our model at Token Metrics, a significant support level. So whenever it dropped below the 20K, we knew that the next level was 1920. And then that 1920 was going to, if it got crossed, it's going to get crossed very quickly to the next level, which is 1750, that range, which ended up being tested exactly and then rebounded. All right, now let's look at Bitcoin. Same model, let's just look how Bitcoin option open interest was for June 25 across different strike prices. So here, the max pain for Bitcoin was 40K, which means that option buyer will lose the most if it ended up at 40K on June 25, and market makers would make the most if it ended at 40K by June 25. Now, this level got dropped very early before June 22, and we saw that when it dropped, it took out the 36K and then was between this range, between 34 and 32K. Now, looking at the put distribution, we can also really see that there were a lot of puts being traded at 32K and a lot of puts being traded at 28K with no calls in between. So this basically means that whenever Bitcoin crossed this 32K down to the downside, all the market makers had to start shorting Bitcoin to offset the risk associated with all these put options that they had sold. So it ended up crossing this level, went through these levels very quickly because there weren't a lot of options being traded, and then found support where at our support line that our model gives us. Since 28,500 or 28,000 to 28,500 was a significant support level here where it got tested many times. And in fact, during January 22, we tested these levels after the big drop from the previous levels from the open interest of options, tested 28K, and then went back up and shot up, in fact. All right, guys, thank you for watching. I hope you enjoyed this video. I hope you learned a bit more about options, because options, honestly, we can just keep talking about them. They would never end as a topic. This Black-Scholes formula, although it seems complicated, trust me, this is the most important formula of all quantitative finance. It's a living formula, literally. It has so many parts that are changing all the time, and understanding this formula can change all your perception in markets. And it really explains the dynamic of markets, why certain levels don't get crossed, why certain levels get crossed, and why these huge and sharp bounces that we saw on June 22nd. So I hope you enjoyed this video, and see you next time.